Hi everyone, thank you for joining us today. The slide deck can be found in the handout section of your toolbar. Please use the question section on the right-hand side to ask questions throughout the presentation. We'll be holding and answering questions for the end of the presentation. There will be 4 polling questions throughout the presentation. You have to answer at least 3 of the 4 in order to be eligible for 1 CPE credit. Your CPE certificate will be emailed to you in the next few weeks from our Witham Learning team. And now I'll hand it over to your presenters today.
Thank you very much. My name is Lou Young. I've got Dan Mayo with me today and Matt Walsh, 2 very familiar names. We've been covering the PPP ERC landscape for the last close to 1.5 years. Unfortunately, Frank is unable to make it today, but we will cover everything that we talked about. Next slide, Allison. So the agenda today will be to cover the PPP loan forgiveness. We will be touching on the PPP 1 and PPP 2 requirements, things that are going on, some current events. And then we will get into the employee retention credit, the ERC. That should be familiar to many. Applying for a amendment to last year's tax withholdings is one option for 2020, or you can apply for the ERC during the 1st or 2nd quarter in 2021. Dan and Matt will get into some details, and then we will open it up for Q&A. So the first polling question. What is the status of your PPP 1 loan forgiveness? Please select 1. How do I apply for forgiveness? Applied for forgiveness, not yet received. Applied for forgiveness and received full forgiveness. Applied for forgiveness and received partial forgiveness, have not yet applied. How much time do we give them, Allison?
Just a couple more seconds here. I can see almost everybody has answered.
Okay, great.
You give about 1 minute for every question.
Okay, great. 52 have applied, 52% have applied and gotten full forgiveness. That's great. That's good to hear. Hopefully the people who have not yet applied will get out there soon.
Yeah, and Lou, these numbers aren't necessarily surprising. I think the last data that we have from the SBA shows about 30% of PPP 1 borrowers haven't yet applied. So this is the audience today is fairly in line with the what the SBA has out there.
That's great. So PPP 1 ran last year. The covered periods covered basically March, April, late spring through October, towards the end of the year, October, December. So what we will talk about in a little bit is applying for forgiveness and what the time frame is for applying for forgiveness. But at this point, as we said, 52%, we are seeing a lot of clients that have applied at this point, and for the most part have gotten forgiveness. There's a few clients with loans over $2 million that are just starting to see the money coming in, so the forgiveness amount coming in. So that's good. Hopefully people will move on this quickly as soon as possible. And then the PPP2 started in January. We saw several people applying for PPP2, and that period, the same parameters apply, 8 to 24 weeks for your covered period, and then you can apply for forgiveness. And again, we are trying to make sure that our clients are utilizing the forgiveness to the greatest extent by stretching out their period to hopefully 24 weeks. That way you can utilize as much of your wages and your non-payroll costs as possible. So you want to get that up so that there's basically no comment, no issue regarding whether you qualified or not for the forgiveness. And the procedures are the same that we talked about before. You have the 3508S is for any loans below 150,000. You have the easy form that can be used if you qualify, and then you have the long form, the 3808 long form, if you have FTE issues or do not qualify for the easy loan. So let's just look at the easy loan here very quickly. We have two criteria that we've been talking about that you have to meet in order to use the easy form. The first is that you cannot reduce any wages by more than 25%, and we'll talk about what wages are in a little bit, but you can't reduce any wages by more than 25%. And the second is the, you have to check at least one of these boxes in addition to the 25% stipulation. You either have to have not reduced any FTEs, not reduced any, the number of employees, or you as the borrower were unable to operate between February 15th and the end of the covered period at the same level of business activity as before February 15th, based on complying with the stipulations of state, federal, or local mandates. So again, we see a lot of clients that do qualify for the easy loan. There's no restriction on a dollar amount that you have to have. So you can use the easy form for any amount. You just have to meet the two restrictions. And again, that's laid out on the form itself. You can see it as part of the items that do have to be certified. Next slide. So what are the forgivable expenses? We started off last year, we basically had payroll costs and non-payroll costs, including interest payments, rent, and utilities. This was amended at the end of last year for both the PPP-1 and PPP-2 programs. So forgivable expenses include all compensation to the employee, plus any employer payments for group life, disability, vision, dental, retirement, and state and local taxes. That's pretty much the same. They added the group life and disability for additional amounts. The non-payroll costs is where we saw the biggest changes, the incremental changes in expenditures. Added to the list were covered operation expenditures. That includes payment for any business software or cloud computing service that facilitates business operations. Again, this is a broad area, but basically we're talking about software or computing services that were part of your operation. So that's one item that was added. Go to the next slide. We've got a few more here. We've got the covered property damages. These include costs related to any property damage that occurred during 2020 due to any type of public disturbance that was not covered by insurance or any other type of compensation. So these are property damage costs. You've got covered supplier costs, expenditures made by an entity to a supplier of goods. which are essential to the operations of the entity. That were in effect at any time before the covered period, or with respect to perishable goods, in effect before or at any time during the covered period. So these are supplier costs. A lot of these are stipulated for restaurants, but obviously many businesses have supplier costs that would be included. The last category is the PPE, personal protection expenditures, for any type of equipment purchased in operating or capital expenditures to facilitate the adaptation of the business activities in order to comply with any of the requirements related to the maintenance of standards for sanitation, social distancing, or other work safety requirements related to COVID-19. So we're talking about the personal protection equipment, anything like masks or screens that were put up, or anything that you needed to do to your facility in order to meet any type of sanitation or social distancing requirements. And again, these are for anybody who has not applied for forgiveness yet. Next slide. When does the loan repayment start? This is a popular question. So the borrower may submit a loan forgiveness application at any time before the maturity date of the loan, if the borrower has used all the loan proceeds for which the borrower is requesting forgiveness, except for anyone applying for a loan less than $150,000. You have to do it prior to your second draw PPP loan application. So unless your loan's below 150,000, you have to apply prior to any second draw loan. If the borrower does not apply for a loan forgiveness within 10 months of the last day of the covered period, your loan is deemed to be no longer deferred, and the borrower must begin principal and interest payments. So basically, you have 10 months to get your forgiveness application in, and at this point, we're talking about for the first PPP loan. Next slide. So a couple miscellaneous questions here, and then I'll hand it over to Matt and Dan. For furloughed employees or hazardous pay during the covered period, you can include any type of compensation paid to those employees in the form of salary, wages, commissions, any type of similar compensation. Just keep in mind that any of the compensation cannot exceed an annualized salary of $100,000, which would be for that covered period. Are there caps on the amount of loan forgiveness available for owner employees or self-employed individuals, own payroll compensation? Yes, and we've talked about this. We should be familiar with this by now. Owners were restricted to 2.5 months of compensation, up to a maximum of 2833. So we've talked about that number a lot. If you are submitting a forgiveness application and you're using your payroll information, your owners are maxed out at that 2833 number. Hopefully that's familiar to all the owners by now. Next slide. And again, we talked about this before. I said I would mention it again. You are restricted. If you're going to use the easy form, you have to certify that you haven't reduced any salaries or hourly wages by more than 25% during the covered period, as compared to the most recent full quarter. So again, what does this mean? So if you have an employee that works 40 hours and is getting paid $1,000, $25 an hour, if the employee continues to work 40 hours but gets $500 for the week, a 50% reduction, then they would be considered as having their salary or wages reduced by more than 25%. But if you have an employee that gets paid $500 per week, but is only required to work 20 hours, then you don't have the salary reduction because the hourly rate is the same. But you do see the FTE reduction going from 1 to 0.5. But hopefully that doesn't matter. If you're using the easy form, you won't have an FTE issue. So with that, I just wanted to cover some of the latest news. Next slide. As I mentioned early on, we're seeing a lot of loans that are being approved over $2 million. That started in the last 2 weeks. So we see the SBA moving forward with their forgiveness applications. Obviously, a lot of our clients saw the additional questions that were coming out. They answered them in a timely fashion, and many of them have gotten their loan approved. So with that, the only thing else I wanted to mention, we have heard some rumbling about the 3509, 3510 forms being discontinued. We haven't seen any official word on that yet, but we are keeping track of it, and we will let you know for loans over 2 million if that's something that comes up. Matt?
Sure, Ali, can we go to the next polling question, please? Thanks, Lou. All right, so second polling question here is just related to your PPP2 loan. If you received a PPP2 loan, which form do you currently believe you'll utilize to file for a loan forgiveness? Do you think you'll use the 3508S, that means your loan's under 150, the 3508EZ, or the 3508 long form? Again, the 3508S, that's for those who are under $150,000, 3508EZ, or the 3508, which is what we call a long form. How we doing on responses, Ali?
80%, but it's been about a minute, so we'll close it out now.
Okay. All right, and here are the results. So we have about a little under half going towards the EZ form, about 33% going towards the S form, with the remaining 20% going to the long form. It'll be interesting to continue to see how this develops. You know, when the first PPP loan happened, we saw a lot of businesses use that business activity certification under the EZ form, which, you know, meant that their business was not able to operate at the same level as before the covered period, due to the guidance issued around the around the pandemic. But with the PPP2 covered period being more toward 2021 and some of those restrictions releasing, we are interested to see how the how those borrowers continue to contemplate whether or not they meet that certification. The next thing that we wanted to discuss is the employee retention credit, right? And the employee retention credit is really something that all business owners should now be considering. Just in general, it's a fully refundable tax credit for wages paid to certain employees during periods of economic hardship. The employee retention credit has been around since last March, right? It did come out in the CARES Act, same legislation that gave us the Paycheck Protection Program. But if we recall, originally, the Paycheck Protection Program and the employee retention credit had a prohibition of utilizing both, which meant you could only get one. Pretty quickly, pretty early on, companies realized that the better of the two was the Paycheck Protection Program, right? So this was a little used program for the most part for those borrowers who received PPP, but at the end of December, when we saw the Consolidated Appropriations Act pass and become a law, right, we saw a major shift in that legislation not only expanded the employee retention credit into 2021, but it also allowed borrowers the PPP to partake in both programs. You know, down here, there's a list of some of the guidance that has come out. We've received, obviously, the legislation in December. We've received the IRS notice. We've received the American Rescue Plan Act, which is another piece of legislation that further adjusted the criteria and changed the statute of limitations for an IRS audit on the employee retention credit. And then finally, we received another notice from the IRS, which addressed the second quarter or the first 2 quarters of 2021 in the employee retention credit. What we also expect is that in the coming weeks, I would say, as we roll into Q3, we'll also get another notice for 2021 for quarters 3 and quarter 4. So we'll be on the lookout for that. Can we go to the next slide, please? Thank you. So what we thought best was to sort of do an overview of the employee retention credit, and then we'll get into some of the weeds on some of the more, some of the more detailed calculations, right? So just as a very high level, right? And again, this is something that many business owners had considered previously, but with the changes in the rules and the guidance that's come out, we really do think it's imperative that all business owners reevaluate their eligibility for the employee retention credit and see whether or not they could benefit from the program. We know that there are two, we like to bifurcate the programs almost into 2 separate ones, right? The 2020 program and the 2021 program. And the reason for that is that the eligibility criteria are very different. The amount of the credit is very different. And the way that you would calculate the credit is also different, right? So when we look at eligibility, there are really 2 ways to get into the program. The ways in which you get into the program don't necessarily change. You either could be subject to a full or partial suspension of business operations, right, due to a government order, or you have a quarterly drop in revenue, in gross receipts, in a particular quarter against the same quarter in 2019, right? For the 2020 program, right, that quarterly drop in revenue is 50%. So it is a much larger number, right? 50% revenue drop in any one quarter as compared to the same quarter in 2019. Once you become eligible for the 2020 program, you continue to stay eligible until you get through the quarter that you got back above 80%, right? So quick example, in quarter 2, 2021, you dropped 60%, right? Or sorry, quarter 2, 2020, you dropped 60% as compared to quarter 2, 2019. You start becoming eligible in that quarter. If in the third quarter you got back up to 100% of your sales in the same quarter in 2019, you would stay eligible through the third quarter, right? So you always get 2 quarters there. For 2021, however, that 50% number drops. It drops from 50% down to 20%, right? So in 2021, if you have a quarter that's down only 20%, and we always look back to 2019, right? Always look back to 2019. So if you drop by more than 20% in gross receipts, then you would become eligible. The other thing that the 2021 credit offers that the 2020 credit did not is that you can elect to use the previous quarter to test your eligibility, right? So what this means is that if you have a quarter in which you're down 20%, you automatically get the next quarter, right? Because in that quarter, you would elect to make to utilize the previous quarter to test your eligibility. What it also means is that for businesses who don't necessarily have a reduction of more than 20%, you could still qualify for the first quarter if you had a reduction of 20% or greater in the fourth quarter of 2020 versus the fourth quarter of 2019, right? When we look at the qualified wages, there's also a stark difference between the 2020 program and the 2021. For the 2020 program, the qualified wages is up to $10,000 in total for your entire period of eligibility, right? So if you were eligible from March 13th all the way to December 31st, the maximum you can get there is $10,000 of qualified wages per person. For 2021, however, they split this up into a quarterly analysis, meaning that each quarter you could be eligible for up to $10,000 of wages. So we've seen a lot of communication out there. Get your $33,000 from the employee retention credit, right? And the way that those numbers are coming up is that they're assuming you would be eligible for the full $5,000 in 2020, and then also $7,000 per quarter for the full year of 2021, which would be 28,000 in 2021. So that's how they get those numbers when you see those emails and those headlines. Next slide, please. When we talk about the credit, right, we look at that 10,000 of qualified wages, and in 2020, you get 50% of it, right? So max of $5,000 of credit for 2020. For 2021, it is 70%, right? So the 2021 program, as you can tell, is much more favorable, right? We'll skip over the advance payments because it's not a significant portion. Next slide, please. A couple of things, pretty important distinctions here for in terms of covered employees, right? There is a large difference in the amount of the credit if for the 2020 credit, if you had more than 100 full-time employees, right, there's a fairly significant difference in the credit. Once you get over that 100 full-time employee mark, and again, we always look at 2019 to determine, so we look at 2019 full-time employees. Once you get over that 100 employee mark, what happens is you're limited for your credit to only the wages that you pay people not to provide services. We like to call these people the Netflix employees, right? The people who are not working but are getting paid anyway, right? What was good about 2021 credit was that Congress, when they passed the legislation to expand it, increased that 100 number to 500, right? So you're looking, if you're under 500 full-time employees, you can get credit for all of the wages you paid to employees, right? So that's fairly significant, right? As with all federal programs, right, we do need to make sure that there is no double dipping. So there's an important calculation to be done to make sure that you're not utilizing the same wages toward the PPP and the ERC. Dan Mayo is going to touch on this a little bit more later, so I don't want to go into too much of the detail there. Next slide. We added a couple more. These are really summary slides just to talk about the key eligibility differences and kind of point them home, right? So we do have a lot of conversations with clients and prospects and businesses out there that these rules are very confusing, right? So we wanted to make sure that we included in here in a simple fashion. For the 2020, again, you're looking at a greater than 50% reduction in gross receipts in a quarter, and for 2021, you're looking at a greater than 20%. Next slide. The other thing that we get a lot of, right, is to sort of talk through this idea of whether or not the business was subject to a full or partial suspension of operations, right? Because for those businesses who weren't necessarily down the requisite amount of gross receipts, there is still a way to qualify into the business, right? So when we look at a full or partial suspension, you really have a three-part test, right? You have to have been subject to a government order that restricted operations. The order had to limit commerce, travel, or group meetings. And the order has to affect the operations of a business in a non-trivial manner, right? So what they look for is, right, you're going to look to see if your business has shut down partially or fully, is you're going to look to a government order, right? A government order that was put in place by state, local, federal government that affected your ability to do business, right? Unfortunately, it can't be press conferences or interviews or any statements of local government officials. It must actually be orders. The most common we see here are the executive orders of each of the individual states that were passed or were signed by the governors. What's important is that more than a nominal portion of the business must be affected, and the IRS in their notice has outlined a safe harbor that identifies that nominal means that more than 10% of gross receipts or 10% of total hours of service, if you're a service business, performed by all employees would demonstrate that you've met the more than nominal threshold. Right, so the way that you would think about this, right, is you look to see what are the portions of my business that were affected by a government order. Right, so this portion and that portion of my businesses were affected of the government order. And then you look back to 2019, you say, well, how much of my business do those portions actually make up? Are they more than 10% of my gross receipts? Are they more than 10% of my total service hours, right? And if so, then what you have is you have a more than nominal portion of your business was shut down partially or fully, right? Some common examples the IRS gives, and albeit they don't necessarily cover every specific circumstance in the IRS notices that they give, but some common examples they give are reductions in seating capacities for restaurants, movie theaters, reductions in hours of operations. We saw that a lot in the retail industries. an order that prohibits suppliers from making delivery of critical goods. So if you're shut down due to your suppliers not being shut down, that could constitute a partial shutdown. And then finally, a partial closure of operations. One of the biggest examples they give here is elective surgeries for those in the healthcare field who rely on elective surgeries being a large portion of their business. There was, many states shut those surgeries down for 2, 3, 4 month periods at a time, which could lead to a partial suspension for them. They also give a couple examples of what does not meet the test, right? And what does not meet the test is in the circumstance that a business can run their operations comparably through telework, right? There's a list of considerations that you'd have to think about as a business who could potentially work comparably, and that includes whether or not the employer has a telework capabilities, the portability of the work of the employees, the need for the presence in employees' physical workspace, and the amount of time that it takes to transition to telework operations. The IRS has made it clear that a small period of transition is to be expected and does not necessarily lead to a partial shutdown. I think that the example they use is 2 weeks, right? So if it took you 2 weeks to transition to a telework environment, unfortunately, that doesn't qualify you under the partial shutdown. The other thing that they make a point to talk about is if you have a business reduction due to reduced demand, right, as a result of government orders, meaning there was a stay-at-home order issued and you're a retail establishment and the retail establishment could still stay open, but the stay-at-home orders meant none of your customers came in. Unfortunately, the IRS says that this does not constitute a full or partial suspension of operations, but if you did have a reduction of demand, go ahead and look to the reduction in gross receipts to see whether or not you would qualify that way, right? Next slide, please. The other test is the declining gross receipts. Again, we put the details here so that you can see what quarter you're going to look to and how you're going to test. But we've identified this before, so we won't spend too much time on it. Next slide, please. I think it's a polling question, actually, Ali. All right, so as we just talked about, how can a business qualify for the employee retention credit? We have a 50% gross receipt reduction in any quarter in 2020, 20% gross receipt reduction in any quarter in 2021, a full or partial suspension of operations due to a government order, all of the above or none of the above. Oh, wow, this one's tracking pretty good. We've got 90%, 92% of the answer toward about 90% of the answer going towards one of the selections. All right, Ali, how are we doing on this one? I think we got a pretty high 85% voted.
Yeah, I'll close out now.
All right. All right, so 84% all the above, and we definitely agree there. All right, so with that, I'm going to pass it over to Dan. Dan, why don't you take us through some of the more nuanced discussions around the ERC?
Great, thanks, Matt. So we're going to start now with the definition of gross receipts, right? So what does it mean? You need more than 20% of decline in gross receipts in 2021, more than 50% in 2020. The IRS refers to the definition by reference to another code section, but it's a very broad term. Essentially means all of your revenue. It's your total sales net of returns. It is amounts received for services, any investment income, and any other incidental sources of income, right? Like the employee retention, like the PPP, for example, when it's forgiven. It includes interest, dividends, right? All that passive income there, regardless if they're derived in connection with the business. The key here is it's not reduced by cost of goods sold, but you can reduce it if you have basis in a capital asset sold. So if you buy stock for 100, sell it for 50, you have a $50 capital gain. 50 is your gross receipts. But with your sales, you don't reduce it for any expenses for cost of goods sold. It's the net number. That's the key there. And of course, you wouldn't include any amounts that are loans because it's not a gross receipts because it's a repayment obligation, and those other minor items there too about sales tax. For tax exempts, a similar definition. It's basically it's your top line revenue number. We do recommend, as the rules say you have to do, employers should keep their records for the decline in gross receipts for a 4-year period, and probably longer because the IRS, the statute rather, extended the statute limitations. So the IRS can assess now. Usually it's 3 years for the IRS to assess, 6 years in the case of a material omission. They've extended that to 5 years in the case of the employee retention credit without regard to a material omission. So that's a pretty good indicator that they expect the IRS to audit this thing for years to come. So be prepared with your documentation. The best time to do that is when you apply for the credit, since you would have had to have run through all the traps to qualify. And one of the things we do is sort of gather that information for people and then put it in a easy format so they are prepared when if and when they're audited by the IRS. Next, also aggregation rules apply. So you need to aggregate your entities that are related. We'll cover that in a later slide, but aggregation applies for purposes of the gross receipts test. Next slide, please. So here we talk about aggregation. If you have to aggregate, what it says is multiple employers are treated as a single employer for purposes of the employee retention credit. There are 4 purposes for which you have to aggregate. So the two tests of eligibility, the full partial shutdown rule, the declining gross receipts rule, also the 2019 FTE calculation. And remember, as we said before, it's not a full-time equivalency calc like with the PPP. It's truly the number of employees who work in the US and work more than 30 hours a week or 130 hours a month. So the key there is that they do have to work in the US. And then the last one is determining the maximum credit per employee. So determining each employee can receive up to $10,000 of wages in 2020, well, all periods, but $10,000 of wages is the maximum amount, and then the credit percentage varies depending on the year. The aggregation rules refer to section 52 and 414. Those are used in other sections, so there is guidance out there. The typical aggregation you see is parent, subsidiary, brother, sister companies or partnerships. And the rules are for, it's more than 50% for the parent sub context. When you get into brother, sister, or sibling aggregation, you're looking at there's an 80% test and a 50% test, whether you're owned by 5 individuals, own more than 80%, and then you have common ownership of more than 50%. And then the employee retention credit, although you determine eligibility based on an aggregate basis, you do have to apportion the ERC out to the various members for purposes of actually claiming the credit in each quarter. So, when you do this, you have to aggregate, and then you sort of disaggregate for purposes of apportioning the credit. I just want to mention here also, we've said this numerous times, not today, but in other contexts, the aggregation rules are different than the affiliation rules. And the only reason we stress that is because a lot of people want to do their own research. Sometimes they want to Google things. And if you Google affiliation, that's a PPP concept. Aggregation is the ERC concept. Next slide, please. So qualified wages. The qualified wages are the base upon which you apply that 50% or 70% credit. And in 2020, it's $10,000 per year from March 13th. The total eligible period is March 13th to the end of the year, and up to $10,000 per employee. In 2021, it's the entire year, except you reset it every quarter. So it's up to $10,000 per employee per quarter. You also include the qualified health plan expenses as you do for 2020. The exclusions, the exclusions, wages paid to related or persons related to the greater than 50% shareholder, persons related to the sole proprietor. Note that a spouse is not included here. So, it's children, siblings, parents, step-parents, nieces, and in-laws, certain in-laws, but the spouse is not included. I guess they contemplate the spouse working in some businesses so they can receive the wages and get the ERC, mostly in the self-employed and sole proprietor context. Severance, for other payments is excluded. It's if it's paid after they're terminated. And also wages that are exempt from Social Security tax are excluded. So this is independent contractors who get a 1099. Also, church employees or parsonage that's exempt. So if it's just not 3121 wages subject to FICA taxes, which are Social Security and Medicare, then those are they're exempt wages, do not count for purposes of the ERC. The difference between the partial suspension test and the gross receipts test is that the partial suspension test, you can only count wages that occur during the partial suspension period. So if there's a 70-day period, like in the case of the suspension of the surgeries, the elective surgeries, in many states it was around a 70-day period. We have a lot of clients. I only remember that because we have a lot of clients who work who are in that space and have obtained the employee retention credit. Then you only can add wages during the period of the suspension. Whereas if you're in the gross receipts test, you get the entire quarter. So if you get Q2 of 2020, you automatically get Q3 because of the rule that says you keep including wages until you recover to more than 80% of your 2019 gross receipts. So you automatically get 2 credits. The interesting thing about 21 is if you qualify in 21 based on your first quarter numbers in the gross receipts test, you automatically get Q2 because of the election to use the prior quarter. But if you qualify in Q1 based on your election to use the prior quarter, Q4, you don't automatically get Q2 in 2021. So this is a small caveat there that you get Q2 automatically or the following quarter automatically if you qualified on the previous quarter based on the numbers of that quarter. Next slide, please. You do include a qualified health plan expenses, as we talked about, and you can include a proportionate share of them even if no cash wages are paid. So this comes up in the case of furloughed employees. Also, the following items are included. There's a list there. I won't go through them all just in the interest of time so we can have time for the many questions that have come in. And there's a bunch of excluded items there. We put the list here in case someone's doing it themselves who just wants to tick off the items that are included. Also, you can't double dip, but we'll see this on a later slide here. You can't double dip with the wages that are reimbursed under the PPP, the FFCRA qualified sick or family leave provisions. You have some PATH Act R&D credits, the work opportunity tax credit, that sort of thing. So next slide, please. Limitations. So this is a key one. This really determines the amount, is crucial to determining the amount of the credit. There's a difference between, they call them small employers and large employers, and it varies. The 2020 and 21 credit has different tests. It's a 100-person test in 2020 and a 500-person test in 2021. But if you have less than 100 employees, full-time employees, and again, not a full-time equivalency, just full-time employees in 2019, that's always your base period. If you have under 100 in 2019, you can include the wages in 2020 of all your employees. If more than 100 in 2019, you can only include the wages of your employees in 2020 that you were paid not to work, which is usually a rare thing, right? Most businesses only pay people to work. So that 100 breakpoint is crucial to determining the amount of the credit. If you're under 100 employees in 2019, but you have 150 employees in 2020, you can receive the credit on all 150 employees for paid time off and for paid time work. So it can be a sizable credit being under this number. Being a small employer is a crucial determination. Same thing for 2021, except it's broadened to be 500 employees. So we have some clients, there's 490 employees in 2019. They're considered a small employer for the 2021 credit. They've since grown and they're now at 800 employees. They can receive the credit up to $7,000 per employee on all 800 people. So it's you can get into the millions very easily per quarter with the 2021 employee retention credit. Next slide, please. We talked about this. This is the full-time employee calc. It is based U.S. employees that work in the U.S. physically. It's average of 30 hours a week or 130 hours a month. It's not in full-time equivalency calculation like with the PPP. So it is different. Next slide, please. There's a special rule here for M&A. There's also another Q&A 28 in the notice. It's the one that addresses this. There's also one for starting businesses in 2019. You know, occasionally you get clients who fall between the cracks there. But this rule says that if you acquired a business in 2020, you're going to, by definition, right, you'll have wages, you'll have gross receipts in 2020 you didn't have in 2019. So you're not likely to qualify for the credit. What this rule says is you can go back to 2019 if you know those wages, and you can include them in your base period. This way you're comparing apples to apples. So they allow for that kind of comparison, even though the business was not owned in 2019. They allow you this safe harbor to use that, and then you can make an apples to apples comparison. If it dropped, then you can qualify for the credit. Next slide, please. The taxation of the ERC, this is very important. So we always remind people that the employee retention credit is taxable. It has to be included on their tax return, not so much as an item of gross income, but it's in the form of expense disallowance. You know, much like with the PPP before they changed the rule to turn off expense disallowance. But the aggregate deductions are reduced by the amount of the employee retention credit, which means it's taxable. It applies in both credits, 2020 and 2021. For 2020, you know, it reduces the wages in 2020. You can't go forward and apply it in 2021. So each year's credit will reduce the wages in that year. Next slide. So we'll turn to polling question number 4, Ellie. Do you believe that your business will be eligible for either the 2020 or 2021 ERC? Well, it looks like a good number of people are being honest and saying they're here for the CPE. Either that or they have a very good sense of humor. Okay, we're up to almost 80% of the vote now. Just see if we can get those in quickly. We'll save some time here at the end for questions. I know we got a bunch of them that have come in on the PPP, also the ERC. And we'll get to as many of them as we can. Okay, we seem to have maxed out here with the vote. How we do? There we go. Okay, so yes, 41% expect to, maybe a 16, no 22, and 22 say I don't have a business, I just want the CPE credits. Next slide, please. So the interaction, we talked about this, you can't double dip, so you have to remove wages that were necessary for the PPP, you have to remove sick leave, family leave wages, and the others listed there. What this means is it's an exercise for mathematical exercise to reduce them in a way that's most favorable to the ERC. So there's an art to this, not a science. There's no methodology for how to do it. And so, there are ways to do it that maximize the amount of the ERC. And, we've developed a way to do this algorithmically, so we don't do it manually. So the goal is to allocate as much wages as we can to the higher paid employees for the PPP so that we have wages left over to allocate for the ERC to fill everybody up as much as we can. And so that's the method we use here at Witham. What if I took advantage of the employer payroll tax deferral? Has no effect on your ability to claim the ERC. Just affects the amount you can request in advance credit. Also, keep in mind if you want to deduct the payroll taxes if you're a cash basis taxpayer, you got to pay them in 21 to get the deduction in 21, which is due by the end of the year, half by the end of this year, half by the end of next year. If you're an accrual basis taxpayer and you want to deduct it in 2020, you do have to pay it by September 15th. So you have some time. If you don't pay it by September 15th and you rely on what's called the recurring item exception, you can deduct it back on your 2020 tax return. If not, and you pay it in 2021, you'll deduct it in 2021. So there is some electivity here on whether you want this deduction on your 2020 return or 2021 return. Keep in mind that's out there. I'll be writing an article on this probably in the next week or so. So I'll lay this out in more detail if you're interested in learning more about this, because I know it's coming up for a lot of our clients, and we're starting to get a lot of questions on, when do I get the deduction? Next slide, please. How to claim it. For 2020, it's retroactive. You go back and get a refund on Form 941X. Same thing with 2021, you get a refund on 941X. You can go for advance payments on the 7,200 like you did with the sick leave credits. So that option's available. For most clients we see are doing it in the form of a refund claim. Very few are opting to reduce the amount of their deposits for the amount of the anticipated credits. We're just not seeing that. And I'm sure it's done by some people. We have very, very, very few clients who've done that. Next slide, please. So how to claim, you can reduce your deposits. As we said, there's an advance payment mechanism. We won't spend a lot of time on that here, but do plan for an audit, retain your documentation. There will be extensive audit activity because of the 5-year statute of limitations. So please don't forget, while everything's fresh in your head, now is the time to document it and be ready. Next slide. Great, so here we have a lot of links and resources. These are all hyperlinks, so it'll take you right to the document. As Matt said earlier, we do anticipate another round of guidance, another notice coming out in the very near future on the second 2 quarters of 2021. Probably not much difference. So the first notice in March was 102 pages, I think. It's sad that I know this. And the second notice, 2021-23, was I think around 17 pages. And so my personal view is the next one will be even smaller because they're relying on the prior guidance. There's not much new. They will have to address those severely depressed businesses. There's a couple new concepts that come in Q3 and 4 that are in the statute, that is new section 3134. So they may address them in the notice, which may make it longer. But so there's not likely to be that the guidance is likely to be consumed by that type of new information as opposed to regurgitating the old stuff. So with that, I think we'll go to the questions now.
Yeah, sure. So the first question we see in here, we'll dive right in since we have about 8 minutes left here. First one is lenders have been reassessing the amount of the loan that businesses should have gotten while they were applying for forgiveness. Is this common? Is this okay to do? What's the thought with that?
Assessing, I mean, they've been reassessing. We haven't seen too many major changes, but they certainly are questioning whether certain items should be included for eligibility. But once those questions are worked out, most of the loans go forward and are forgiven.
Right.
I guess there are some where we do see some issues that come up, but for the most part, most of the questions have been answered by the clients and they have not had an issue.
Yeah, and I think the SBA did address this, and they said basically a borrower can't apply for loan forgiveness on anything more than they were entitled to receive in the first place, right? So if there was an error, an unintentional error, obviously, in the calculation of the loan amount, and it's discovered as the lender does their reasonable review or the SBA does their reasonable review, then the loan amount does need to be adjusted. Meaning if you got 500,000 and you're only supposed to get 400,000, and it's discovered that the calculation was unintentionally incorrect, you will have to reduce your loan amount down to the 400,000 and pay back the remaining amount.
You do have one important question, if I can address, Matt. Frank is not on vacation. Something urgent came up, so he's not a dirty rat. He is definitely, something urgent came up at the last minute today, so he did plan on being here. Sorry, go ahead, Matt. I didn't mean to interrupt you.
Sure, no problem.
Any questions?
There's a few questions in here that ask about a forgiven PPP loan versus the PPP loan proceeds and when they should be considered for purposes of employee retention credit receipts. Do you want to talk about that one for a minute, Dan?
Sure. So we get this question a lot. So the PPP, when you first get it, it's a loan, and it is a loan until it is forgiven. So our view is that you take it into account the gross receipts in the quarter in which it was forgiven. At that point, there's no longer a repayment obligation, and it would be considered part of your gross receipts, even if it's tax exempt income.
Right. And then there's a couple other questions as we talk about gross receipts, Dan. Can you talk a little bit about the investment income and potentially having around capital gains, realized gains? Do you get a reduction for the cost basis or no?
You do. You get a reduction for cost basis. No cost of goods sold for services, for items that inventory items, but for investment assets, you do get a deduction for the basis. So you would just include the amount of the gain.
Okay.
It does not include unrealized gains, correct, Dan?
Correct, right. Yes, it is a good question. We get that a lot. If you're putting unrealized gains on some of your tax return forms, you do not include that. That's to be backed out.
Right. And then just rolling down the gross receipt questions, cash basis, accrual basis, what should they be using?
Using for what? I'm sorry, I didn't see the question.
Using for purposes of determining their gross receipts to see if they meet the 20% reduction for.
Yeah, the same basis that they use for tax purposes. This is a tax determination. It's a tax issue. So if your overall method of accounting is cash, use that. If it's your overall method is accrual, you would use that.
Okay. We have a couple questions in here about whether if you filed for the PPP ahead of knowing you were eligible for the employee retention credit, could you go back and amend your PPP application? Are you kind of stuck with what was filed? How does that work?
It looks like you are stuck with what you filed. We have not seen banks allow customers to go back and amend their PPP forgiveness. So, usually we can get it to work out depending on how much overage you had on your PPP loan, how much wages you had over your PPP loan.
Yeah, we need the key here. Yeah, the key here is flexibility. So the more you use, the more weeks you use, the more flexibility we have to maximize your ERC. So the key you want to think about is, one, speak to your ERC advisor. If that's us, talk to us before you file anything on the PPP. Your goal at the PPP application is to use as many weeks as possible to maximize your non-payroll expenses up to that 40% cap. That's the what you should be aiming for.
Right. When we talk about the employee retention credit for 2020, right, we say that there's you are not allowed to take the payroll as a deduction. What happens for businesses who have already filed their 2020 returns? Do they need to go back and amend? And if not, what could be the penalties associated with that?
Yeah, so this is not entirely clear. We believe the better answer is you're supposed to amend your 2020 return for the 2020 employee retention credit. It's not clear the outcome if you don't. I still expect they're going to come out with some guidance on this. Maybe I'm just being overly optimistic. But our view is it's a 2020 issue. There's some very limited guidance in a related context that suggests you should amend and go back and put this in 2020. So that's the advice we're giving people.
Right. Okay. Just a couple of questions here around the partial shutdown of operations. If your business was deemed to be a essential business, or at least a portion of your business was deemed to be essential, does that automatically knock you out of having a full or partial suspension of operations due to a government order?
No, not at all. So, medical practices were essential, but they had the non-essential surgeries were shut down. So you need to look at the individual business and how it was impacted by a government order. The one thing we do see a lot is the order has to affect your business directly. The IRS has taken a somewhat narrow view. The statute seems to be broader. The statute says that you have to have a shutdown due to a government order. The IRS says the order must affect you personally. It can't be someone up or higher in the supply chain. So if it's your customers that are impacted and you have a lower demand, that would not be a partial shutdown because the order didn't affect your business, it affects your customers. So that's something that's out there. It's an issue that's out there.
All right, I think this is the final question that we have time for, the all-important cash is king question. How long has it taken the IRS to get companies who apply for the ERC the cash?
Matt, I think you're the best person to answer that one.
Yeah, so originally this was like 6 months plus, but we're seeing it really come down. A couple weeks back, the IRS issued what seemed to be an innocuous message that they had, quote unquote, caught up on their mail. which is fairly important, especially for the employee retention credit, because all of the amended payroll tax returns are filed paper, which means that they've caught up and processed all of those returns, and they're doing that a lot more quickly now. So we've seen this 6 month plus range toggle down to 1 to 2 months. Hopefully it stays that way.
Yeah, one thing I'll mention too, just because there were a lot of questions on it, we're not likely to see a PPP3. I know that question came out. It's not on the, you don't hear it talked about. The thought sentiment, at least among Republicans, is that there's no longer a need for stimulus. So it's not in the latest Democratic proposal. So right now, we don't think there's going to be a third one.
Took the words out of my mouth, Dan.
Oh, okay.
So I think that's everything for today. We thank everybody for being here with us. If you have any questions, as always, please feel free to reach out to one of us. Our contact information is in the slide deck. Please also feel free to reach out to your Witham advisor, and we're happy to answer those questions. Hope everyone has a great day.
Thanks for joining.
Thanks.